Welcome to Macro Bites with EY-Parthenon Chief Economist Greg Daco. In this episode, Greg is joined by EY-Parthenon Mergers and Acquisitions leader Elizabeth Kaske.
Elizabeth, welcome to the show.
Thanks for having me, Greg.
So I often talk about U.S. exceptionalism, an environment where we have strong growth, around 3% for GDP. We have an environment where the unemployment rate is at 4%, where CPI inflation is approaching 2%, and where we have very strong productivity growth. This is a very good environment from an economic perspective. Yet when we look at the deal market, it's somewhat underwhelming. Do you know some of the reasons behind this softness in the deal market?
Yes, thanks, Greg. So M&A is cyclical, and we are in a cycle right now. Our latest CEO survey lists the reasons why CEOs are a little bit more hesitant around deal making. One of the first came up was cost of capital. So we've seen higher interest rates, higher costs to borrow. The second area is around the regulatory scrutiny. So nothing kills deals like time, and regulators have been using an hourglass to kill many deals in the last administration here. The other thing is geopolitical uncertainty and high valuations, and then all of the advancements in technology and question marks around what does that mean for the competitive landscape. And so there's been a lot of questions around what of these five forces are going to shift in 2025 with the new administration. So I understand you have a deal barometer
I do.
that measures these things and looks at predictions for 2025. What do you predict?
Well, the EY-Parthenon Deal Barometer is essentially a barometer that looks at macroeconomic data and deal market data. And what it does is it's tried to correlate the macroeconomic data with deal volumes. And the correlation is very strong over the last 30 years. So we then use our economic forecast to anticipate what's likely to happen in terms of the deal market. And what we're seeing is quite encouraging. We're expecting growth around 10% for M&A activity. And we're anticipating that the PE market will likely grow around 16%, while the corporate M&A deal volumes will likely grow around 8%. So still a relatively robust market in terms of growth. But I know you're slightly more optimistic than I am. So can you tell us some of the reasons why you're a bit more optimistic than we are?
Yes, so relative to those five factors that were holding back deal making, I expect quite a bit of change relative to those areas, coupled with so much free cash flow and a lot of good value out there in the market. And so we see a lot of our private equity and corporate buyers gearing up and getting ready for a lot of deal making here in 2025. And so I expect that it's going to be a busy year.
And one of the interesting facets there is that a model is good, but it's only as good as its user. So these types of insights where you have more tailwinds that are coming to the fore are generally encouraging. I think deregulation, for instance, is going to be a key factor driving stronger business activity and in turn stronger deal-making activity. But the broad set of policies that will be developed over the course of the coming months will have an inflationary effect. It's likely that we're going to see tax cuts have an inflationary effect, tariffs have an inflationary effect, and perhaps some immigration restrictions also have an inflationary effect. So that's likely to push the Fed towards keeping rates at a slightly higher level than would otherwise have been the case. But I also know that these types of changes to the cost of capital, to regulation, doesn't affect all sectors in the same way. Where are the sectors where you see the greatest hope for growth?
Tech is a leader relative to the deal-making activity. We see tech buying tech, non-tech buying tech, and I think that will continue. There's so many innovations right now around AI, big focus on cyber, data. That is going to continue to drive a lot of the deal-making relative to the tech sector. Then energy, the energy that we need, the ways in which we need energy is only increasing, and so we see a lot of focus around renewable energy, and different types, which will continue to drive deal making in the energy sector. And then finally, healthcare as well. Doesn't matter what the economic cycle is, we all need healthcare.
We do.
And so relative to that, the healthcare industry is incredibly fragmented. And so we're going to see a lot more consolidation happening and scale to get those scale economies relative to businesses in healthcare.
Can you give us some examples of how we're helping clients in the deal market?
We've had a client in the consumer space who has been facing declining revenue and growth. And so we've been working with them on a large-scale transaction, the upfront strategy, looking at what they need to do around innovation and growth with this target, help them through the diligence, and now in the integration planning to be able to go deep into the functions to unlock the value as quickly as possible with this transaction around entering new markets, innovation, technology, and some of the functional capabilities that they can unlock combined together as one organization.
Now, I'm a big sports fan, and I've heard you talk about playing offense and defense in the M&A market. What does that mean?
Companies need to have both an offense and defense M&A strategy. So offensively thinking about how are they going to inorganically grow, and defensively thinking about what is the competitive landscape and how could that shift relative to their M&A plans. And so we are able to help them think through those value drivers very early on relative to their inorganic growth. And our latest corporate development survey showed that 50% of companies who have an integration plan and approach in place before they embark upon a transaction are the ones who actually see greater deal value.
So having the right playbook is really essential, but it's also important to be nimble and prepared in the case something happens that was unexpected. How should companies focus on that unexpected change that could disrupt how the deal market is evolving?
We have something called an M&A stress test, and it's almost like hurricane proofing your house, where you're able to objectively step back and take a look at your business relative to a potential target or set of targets to make sure that you're ready for a large-scale transaction or a different type of transaction. And we look at your business risk, we look at your playbook, we look at your people, we look at your capabilities, and be able to assess what decisions need to be made about the business, what resources need to be in place, and what risks are inherent to the transaction before clients even approach a target or start the due diligence process, and so that they're ready and they know they're ready.
So we talked about a lot in terms of the uncertain landscape, both from a political, geopolitical, regulatory framework. If you had to say, like, as a business leader, here's one logo that you'll put above your office as to how best to navigate the deal market, what would it be?
Measure twice, cut once. Plan ahead for your deal making.
Planning is so important. Thank you very much, Elizabeth. This was a great conversation.
Thanks for having me, Greg.
Tune in next time for another episode of Macro Bites.